That passes. Which brings us to item 5 on the agenda, which is the consent agenda. There are 4 items on the consent agenda. The minutes from July of 11, the California Investment Policy Report, the annual fixed income report, and the home loan program. Are there any pulls? Anybody want to pull any one of those 4 consent agenda items?
Move approval of consent. Which will require action.
Okay.
Second.
Okay. It's been moved, properly seconded. Carolyn?
I need to be recorded as an abstention. I wasn't at the last meeting.
Okay, sure.
Do you want to split it so you
Sure,
can
we could
abstain
do
from
that.
the minutes and
So why don't we
Yeah.
approve the minutes first?
Okay.
So all those in favor of approving the minutes of July 11, 2011, say aye.
Aye.
Opposed? Thank you. And
Could
that-
be abstaining on the minutes also, please.
So 2 abstentions. And then item B, C, and D. Any pulls on B, C, and D?
Oh,
Mr. Chairman, move approval of B through D.
Okay, it's been moved
Second.
and seconded to approve B through D. All those in favor?
Aye.
Opposed? Okay, thank you. Those items pass.
Mr. Chairman, may I ask a question?
Yeah, we want to weigh in there, Jerry? I'll give you the mic.
I
Go ahead,
was trying
Geraldine.
Just a question on the California report. Since it's so money going into California at this point, whether it's from the institutional investors or elsewhere, is very important to all of us. So I'm wondering where this report goes. Does it go to
To the
the
legislature.
to whom?
The legislature.
Perhaps we can have staff come up and maybe just
It's at the
elaborate a little bit
request
about
of the
that.
legislature.
Or Chris, you
It
want
doesn't
to?
go in a big round file, I can tell you that. Good afternoon, everybody. I didn't say that at the beginning of the day. We use it to go to the legislature. We give it to Berman every time he goes over there. And we put it on the web, but we're in the process of trying to kind of clean up our web page so it's a little more prominent and visible. So, and Solange can add more color.
You basically covered it. We try to get the widest possible distribution. We also send it to organizations that are interested in our activities, such as the New America Alliance, the AIM, NASP, and a few others. This report is important to us, and the reason we want the widest possible distribution is because the entire portfolio is included, and it shows point by point what each asset class is doing. So if there's any questions or if there's any suggestions, we welcome them.
So, Jerry, did you have anything else on
No.
that? Solange, while you're there, I appreciate the report, and in particular, the issue about the specifics about the investments directly in California, but the difficulty it is in some of the asset classes and investments to quantify actually how many jobs are created by those investments was something that I recognize. And to the extent possible going forward, that we can quantify. I don't know if we will be able to do a better job, and I applaud the staff for being able to try to dig as deep as you possibly can. But to the extent that we can advance that conversation about if these investments are good investments for the fund, and in fact they are also creating jobs in California for California's economy, to the extent that we can get more details about that, that would be terrific. So as this is going forward, if there's new information that becomes available, I would just ask if it's okay with the board that you forward that to us. I don't want you to go out and create a whole new workload for you, but it's an important issue to all of us.
Currently, there is some legislation that I believe has gone through, it's at the point of being approved, and where the legislature requests that we provide information that we include in the California report, and then in addition to that, they ask us to start discussing and start looking at how we can see what jobs have been added. It is a complex process, I got to tell you. I think we can easily identify the jobs in real estate and private equity. It's a little bit more difficult to identify the jobs in fixed income and global equities. But we're going to be getting together with other pension plans, and we're going to be discussing this very issue, because the legislation doesn't only apply to CalSTRS and usually CalPERS, but it also applies to any pension plan that has that invests more than $4 billion. So we're probably going to be speaking with the LA plans and some of the San Francisco plans as well.
Solange, just for the record, what is the commitment by CalSTRS into California investments again?
We track the total California percentage, and then we have a commitment from the board to invest at least 2% in the underserved space of California. And that's mostly identified by the type of investment, the geographic area, and we track that very closely. But we don't have that I'm aware of, we don't have a particular mandate for California.
Right. I was going to say, and the allocation in California ebbs and flows. Has a lot to do with equity, because it's hard to figure out. Not a lot of companies are still domiciled in California, but we try and gauge what companies are really here with a lot of employees, and then real estate, because that's such big bite sizes. But generally, I tell people between 15 to 16% of the fund is invested directly in the state of California, including the equity portfolio. And then what we've tended to do is highlight specifically some of the real estate properties we own, because they're fairly high profile in different parts of the state. So that's helped as well. But like I said, we send these maps. We were one of the first to do the maps by county. It's helpful for Berman and other people when they go in the legislature to be able to say, boom, I'll pick on one. Butte County, we own something there. And that makes it local to them.
Mendocino County?
We own Dana's house. What else do we own?
Oh, in Butte County, just because Dana asked, student housing, Cal State Chico, we own an apartment complex.
Thank you.
Okay, Carol?
And
Yes, I also wanted to quickly share with the other board members who might not serve on the Benefits and Services Committee that this committee is always interested in our home loan program, and I wanted to commend Solange and the staff. I've forgotten the young man's name. Yes, it's
From the Navy.
hi, Michael. For the tremendous energy and intelligence and creativity with which they have addressed the issues with Fannie Mae and Freddie Mac and all of the changes going on in the housing arena, to the end that we continue to offer this home loan program to our members. It's really extraordinary, and they've really come up with one that works for both the members and the fund, and we're just very, very fortunate to have this kind of dedication and expertise on the staff. We're very grateful.
Go ahead, Solange.
one last point is that, talking about jobs, we have the proactive portfolio, the portion that has been managed by Bank of America. They have a longitudinal study, not only about how many jobs have created as a result of the investments, but also what kind of jobs they are. Are they jobs that are full-time? Are they jobs that offer benefits? And we are going to be sending you that report in the next couple of weeks, so you can have a closer look.
Thank you.
Solange, Chris, thank you.
Thanks, Solange. Lamont, did we vote on B, C, and D?
Yes.
We
Yes,
did.
we
Okay.
Yes.
Well, we probably
Yeah,
should
we
have pulled.
did.
We probably should have pulled them, and out our discussions, but we had them anyway, which is great. Solange, thank you so much. Thanks for the work. Before we go to item number 6, are there any members of the public that have comments that they want to make on items that we have just discussed? Not ones that are coming up, but the ones that we've discussed. Pat Geiger, go to the mic, please. Thanks.
just
Guy.
remember quite a few years ago when we worked on reverse mortgages, and now we are, since they haven't been used, we are stopping that program. But I wanted to commend the staff and the board too. This was in 2000 to 2004 a very good idea. It's something when real estate was increasing, it did meet needs. And I don't want staff to say, oh, we're never going to try anything new again. I think that we need to continue to look at things that meet the needs of our members. And sometimes they work, and sometimes things change, and they don't meet the needs anymore. And I think you've made a good decision to drop the reverse mortgage program at this time. Thank you.
Thank you, Pat.
Thank you, Pat.
So the next item is a pretty meaty topic. I was going to suggest, if it's okay with the committee, that we take a break until 2 o'clock. It's a big item, and we just went through about 90 minutes. So we'll break until 2 o'clock. Thank you. There's, just for the purposes of informing the audience, there's going to be some changes to the agenda. We're going to modify the agenda a little bit. And we're actually going to go to closed session at this point. There's client advisory meeting at this point, so folks are going to client advisory, but we also have a reception at the end of the day, and it just makes better sense that we have closed session now so that it's a smooth transition after the meeting is adjourned to the reception for the audience and everybody people who are coming in to be here for the reception. So we're going to go to closed session right now, and then when we come back from closed session, we're going to do items 7, 8, and 9. So closed session, then items 7, 8, and 9. So if you shouldn't be in the room at this time, I ask that you exit.
To make some suggested revisions to the policy based on your approval to take a portion of the high-yield portfolio in-house. And so that was the primary purpose for this. And then while we were at it, we did some other clarifications. So I don't have any presentation for you. I'll just open it up for questions if you have any.
So Michelle, when would this come back to second reading or for adoption?
It could come back in November.
Okay, so any questions or comments at this point for Michelle on this item? And in the interim between now and November, if anybody on the committee has comments, they could just forward them directly to you, right?
Absolutely.
Okay. All right. Oh, hold on, Beth. Go ahead, Beth.
Okay, given you live and breathe interest rates and we're signing up a policy to direct you in this environment, do you have any commentary yourself on the volatility of the rates? Because you live and you can breathe them, what you think?
Well, I'm
so
not
that
sure
we can read the policy and see if it fits with what we think is going on?
Boy, I would underscore, the entire discussion this morning. I've been in this business for a long time and have never seen the volatility that we've seen over the past, certainly, over the past 6 to 8 weeks has really been a change since the June report. Having said that, it also doesn't feel like 2008 to me either. And to our team, I think that certainly the businesses are more liquid than they were during the 2008 liquidity crisis. But we do still have that global deleveraging process to work through. We think it's going to take a potentially significant period of time. We had an economist in yesterday, and not to bring the entire group down, but her thought was that it would take until 2020 to work through this deleveraging process with mortgages and and certainly with the government's deleveraging as well. So.
And that's not meant to bring us down?
Yeah, sorry about that. Not a great way to end the day. I know it. Sure. So it's a difficult, definitely a difficult period. We've positioned the portfolio so that, to take out as much of the interest rate risk versus our benchmark as we can. And so we're pretty flat, close to home, and, just there to support the other asset classes as we need to.
If we're delevering for another 8 years, what does that mean for rates? Taking the volatility of a daily.
Yeah. Well, up until June 30th, I thought the biggest risk was rates going up. Right now, I don't necessarily view that as an immediate risk. And so I think rates are going to, stay put. They could, possibly go lower. I think there's a lot of artificial propping up of interest rates right now, and I think that's going to continue. And there's a lot of fear and uncertainty, which is driving people into treasuries. So I don't see higher interest rates as an issue. When they do go up, that's going to be, a big move. But I think right now, certainly into the early next year, I don't think we have to worry about rates going up. They could go lower.
Okay, anything else? Okay, thanks, Michelle. For those who just came back in the room, we skipped item 6, and we're going to go to that after we finish item number 9. So if you're here for item 6, you didn't miss it, we skipped it. We're going to go to that shortly. Item number 8 is the real estate policy revision. Mike? Again, this is an information first read for the committee.
That's correct, and this is a revision of only one section of the item, which is the benchmark policy. Because staff is reviewed on the benchmark, Michaelin took the lead on this. It is on because staff has, a possible conflict with picking our own benchmark. Michaelin took the lead on this item, and will be presenting it.
Okay, good afternoon. There are two main reasons for adopting this benchmark as a change to your strategic plan. The primary one is the availability of the benchmark that we had begun working with, and it becomes available to the broad market after your deadline for publication of your returns. So basically, Private Edge, who generates the returns that we report to the board, cannot use that benchmark in their report because it's not available to them at the time that they actually need to be able to generate the report. There are also some issues within the indices because of the newness, that they continue to welcome in new participants as we add to the robustness of the database. And while we want to encourage that, because the more participants, the better off you are, we also look at that and say that means you would have a floating index that basically could change if, for instance, Morgan Stanley decided to put in all of their historical funds. And we are working with all of your managers to ensure that those indices have as many participants as possible. So for those two reasons, we went back to an Odyssey. Odyssey is a group of open-end commingled funds that invest in core real estate. They basically parallel the policy we set up for you for your core portfolio. Stabilized assets in good markets, good quality institutional real estate, a small mattering of specialized assets, and 40% leverage. Is there a problem? Okay. Just want to make sure I wasn't out of line. And so their strategy is consistent with your core portfolio. The participants report on a regular basis. They report on a timely basis. They value their assets, historically, a quarter of their assets each year, but now, as the market's been moving so quickly, they've been doing their full portfolios. So there's not as much of a valuation lag as there used to be. It just generally provides a very good index. We can also, as we were talking earlier, Ms. Rogers, about the gross and net, it can also provide you with a net return to your net return, so we can see if you're doing some value-add strategies in getting your fee negotiations better than market. And those would be the reasons that we're recommending you go to Odyssey. We took the long-term perspective for non-core real estate, for value and opportunistic, and said, what have we seen over the long history, including market cycles, for outperformance over the Odyssey? And that's where you'll see on INV 351 the premiums that we've assigned to each of those, to the Odyssey benchmark for each of those sectors. So you'll remember that when we talked about the value index and the opportunistic index, we liked the fact that they were risk adjusted. They showed the same risks that your portfolio was taking. This is as close as we can get to that until those indices are ready for us to use them as a benchmark. We think the premiums are realistic, and we came to a conclusion of Odyssey plus 100 after many discussions with staff, based on the composition of the portfolio that this board chose to target. So that is the 50, 20, 30 composition of your portfolio. If everything hit the long-term expectations and you were invested at 50, 20, 30, your portfolio should be able to achieve an Odyssey plus 100. So that would be the recommended benchmark.
Pam? Nope. Okay. Carolyn?
I can't find the page, but in your full real estate report, I think you have a chart showing the difference between this, or maybe you have it in this, the difference between this and the former benchmark and our returns. Do you have a
Performance
chart?
measurement report, we put Odyssey into, just to show you what it would be compared to
Yeah,
Odyssey.
is that in open session materials?
Yes, it is. It's in, I think it's IND 121.
121. Right. So that it looks like there's a significant difference in terms of these two benchmarks. It looks like,
Odyssey and NPI.
yeah, it looks like the measurement is really significantly different.
The 18 funds that comprise Odyssey actually all also contribute their performance to the NPI. So they're a significant portion of the NPI.
18 funds,
Commingled funds.
commingled, so this is
They're
all
open-ended
commingled
commingled
funds.
funds.
We're going to use a benchmark that's all commingled funds, 18 commingled
Open-ended
funds.
commingled funds, yes.
That's going to be our benchmark?
Yes.
And in contrast, the old benchmark was composed of what?
It is a property level index. So it's all of the open-ended funds and all of your separate account managers and everybody's separate account managers contribute the performance of each individual property, and that's aggregated up into the NPI, but it is done on a de-levered basis. So so the difference you see, the big difference between NPI and Odyssey is the fact that Odyssey allows up to 40% leverage into its calculations, and it is a levered return. So in the down market, when your portfolio was doing so much worse than NPI, a big portion of that underperformance was ascribed to leverage.
Right.
But
But we had leverage.
which is why we're giving you a leveraged benchmark.
And which one of these do other pension funds use for their benchmark?
It's changing. Will be presenting at IFE a paper on contrasting NPI and Odyssey. A lot of funds are changing to Odyssey because they do use leverage. So it really depends on the client's program. Those that are majority, for instance, LA County is a 90% separate account, all core, 6% leverage. They compare themselves to NPI. That's an appropriate benchmark for them. This system takes additional risk, takes non-core risk, and uses leverage to achieve some of those returns, a levered index that also has a premium ascribed for the additional risk is more appropriate for your system.
What's the PERS one, do we know?
Odyssey.
PERS is Odyssey with no premium over Odyssey.
No premium for, well, do they have opportunistic and?
Their portfolio is quite similar to ours.
So they just have to beat the Odyssey and they get.
That's correct.
Thanks.
Pedro?
Mike, earlier today I posed a question. You were kind enough to come to me and explain. Do you want to take some time now and open mic to answer that for the rest of the board?
My deer in the headlights answer to what CalSTRS was listed as, and I was correct that it was a catch-all category when we were delevering the portfolio. We made loans to some of our partners in the process of delevering them. That asset that was listed as CalSTRS in our core portfolio was a loan we made actually on peers 1.5, 3, and 5 in order to bring that asset into our core portfolio. We did it as a loan because just of the structure of the joint venture, but essentially it's an equity investment, and we will correct that and make sure that that's it's defined independently on an ongoing basis. But that is essentially our equity investment in peers 1.5, 3, and 5, which is a stabilized asset on the waterfront in San Francisco.
Thank you.
Any other questions or comments? Can you elaborate a little bit on K14, the changes to the cash transfer limitations?
This was
Why
done
those
at the
dis-
request of staff to reflect what actually is being done and the way it is being done, so I would have to defer, I think it's Laura? I don't know if she's,
I'm sorry, I missed that,
This
the
is-
question.
So this just reflects,
we adjusted the cash. It does reflect the actual practices, the
This just-
language.
So it's, 14. It's a reflection also of the internal audits as we've been going through them. They've been recommending sort of a standardized on the cash limits in terms of titles and how we describe, but it's wiring money back and forth, not a property level acquisition decision.
all right, seeing no other questions or comments, this will come back to us in November, is that correct?
That's correct.
All right, and if we have questions or comments in the interim, we can just send them to you beforehand.
Please.
Okay, thank you so much. Item number 9 is the corporate governance first reading related to corporate contributions to PACs. Timely topic. Ann, nice to see you. Sue?
Thank you.
This is the first read on the corporate governance, the addition to the corporate governance policy on the oversight by boards of directors of campaign contributions made by the corporations. It's in response to the letter that the treasurer had sent us last spring, and then we had done the education session in June on this issue. As I think we shared with you, this is an issue that is becoming more popular in shareholder proposals. The policy that you see before us, is it not? Really reflects how we have been voting. We want board oversight, disclosure, we want the information. There was language in the materials that was sent, and the treasurer's office has provided some additional language to us that is the new language that's in front of you right now. And so the thinking was to circulate this language, get some more input, and bring back for a second read in November after the members have a chance to look at this. So I don't know if, I know the treasurer's office representative has been active on this issue, so I don't know if there are any questions from the members at this point in time, but the idea was to circulate this additional language and then bring it back for a final read at the November meeting.
Pam?
The treasurer supports the policy, but as Ann said, we had some minor changes to the clarity of the what is political activity. And then Ann came back and had a suggestion to further modify the language here, which we agree with. And so it's what's underlined here at the bottom of the paragraph. And we thank you, Ann, for your work and your suggestion.
Okay. Any other questions or comments about this first read in this policy? Okay. Certainly very timely topic, and we look forward to Brian, you have a comment?
I just want to clarify that this revised language will be posted on our website for the public to review.
Yeah, thank you for that, Brian. Carolyn?
I just want to say quickly that I really appreciate staff's and the treasurer staff's work on this, that I think it's yet again an indication of CalSTRS' leadership role in corporate governance, that I think coming up with policy language in less than a year is really impressive.
Yeah, so thanks to the staff for the work to date, and in particular to the Treasurer's Office for bringing this attention to our board and for us taking action so quickly on such a critical and vital corporate governance issue to our system, and hopefully others, pension funds, will follow our lead with this policy across this country. Okay, so thank you, and we look forward to the report in November, or the adoption. Thank you so much, Ann. Thank you, Philip. We are now going to go to item number 6.
We got our client advisory.
Yeah, I think so. Yeah.
I only see one.
Pat's here.
I only see two then. I see any, I only see two.
Enough already, Dana, this is important.
The chair said, this is item 6, the risk-based discussion on asset allocation strategies. Yes, sir.
From looking out in the crowd, I'm not so sure client advisory is actually adjourned, have they?
I can go let them know.
I don't think they have.
We could do the CIO report.
Let me go.
Yeah, I think this is important that they're here. So maybe we can take a quick break.
It's like a rain delay. It's a rain delay for you guys.
I'm sorry.
So, Chris, why don't we go to your Stephen and Neil?
Hang loose.
Here they come. Are we happy
hold
now?
on
Here they come.
Uh-oh. Does the rain stop me?
Yeah, they're taking the tarps off the field.
Yeah, we're only
Hang on.
de-tarping.
Hold on. Wait.
I'm going to go.
Okay.
Yeah.
Yeah.
Okay.
They got somebody else.
All right, Steve and Neil, the tarp is off the field. We're back playing ball.
We're back.
Okay.
They still haven't adjourned though.
Let's see if we can do this better this time. I want to tee this up before I turn it over to our two experts, just to kind of give you the big picture and then let them get into the details. The one thing I think I want to leave you with in my part is this is a bit on the cutting edge. We're fairly one of the few funds that are really thinking about this. As you know, we've worked on creating the Veritas role, the seeker of truth role. There are other funds who have completely the opposite point of view. There'll be a presentation in about a week by Bob Maynard, the CIO at Idaho Public Employees, taking just the opposite point of view. In fact, it may be so late he's not watching, but in the past he told me he was going to watch today. And very friendly discussion. One of us could be right. We both could be wrong. We both could be right. But I want you to realize there are prevailing points of view that are just opposite of what we're going to recommend to you or suggest to you, because we're both trying to figure out investment theory, and it is not written in stone. As you realize with these markets, it's changing and dynamic as we speak. So with that, Bob was kind enough to share his PowerPoint presentation he's going to make to his board, and I actually borrowed a couple of slides from it that I wanted to show you today. To just kind of take our different perspective on this. So the objective of this entire endeavor has been to manage the risk of the fund and specifically left-hand tail events. So think about kurtosis, the normal distribution. We're worried about the left-hand side. And one of the conclusions we came to last fall was that modern portfolio theory is still the core tenet of our investment fund. But in global markets, it doesn't work as effectively. I've used a slide with teachers, the retiree groups, which they get a kick out of, is that modern portfolio theory, in essence, is the math that proves you don't put all your eggs in one basket. That works really well, except we found out in 2001 and again in 2008 that our baskets were duct taped together. So when they fell, they all fell. And so we said we need more tools. We need more capabilities than that. The other thing, and Bob points that out too, is that the mean variance, the idea that things move back to the average, to the norm over time, doesn't work in a one-day period. It doesn't really even work over a year. The market is so dynamic, it makes it constantly a challenge. There are people who still believe very strongly that mean version optimization is the way you invest over a decade, over 2 decades. I will go back to something Howard Marks once said to your board: being early is indiscriminate from being wrong. If you're too early, you're still wrong, even though in the end you may be proven right. So here's a chart I borrowed from Bob, and I want you to focus in first on the blue line. And you think about that, it looks like your normal distribution pattern of returns that we talk about all the time. The peak of that would be 7 3/4 for us, and we'd expect an equal distribution to the right and the left-hand tail of it. And I think I'll build on something Alan Emkin said this morning. That would be your arithmetic average of expected investment results. But now try and focus on the bars, the red. And that is more of what our geometric experience is from stocks over time. It's an uneven distribution pattern. It has a fatter left tail right now in this last 70 years. But also it has two humps to the distribution curve. Now what's odd is the average still falls in the middle of that valley there, but you can see that the expected experience is going to be to the right or to the left, and the left-hand tail is larger than we thought, and the right-hand tail is a little fatter than we thought. And that's what we mean by kurtosis of the curve. So what we're trying to do is to get tools that help us in with that extreme left-hand tail. By its definition, it should be the black swan event. Obviously, you all know there's a famous book a couple years ago about that. We shouldn't be able to predict the black swan, so I want to go in with that caveat. There are some investors who look at this and say, I'm going to invest for the long term and I'm going to go for the arithmetic average because it's going to come back to that mean. What we're saying is in a defined benefit plan and with fixed contribution rates, we can't handle those left-hand tail events as well. We can't weather that storm that comes through and handle that. We need more tools to be able to deal with it, and that's the difference. This is another chart I borrowed from Bob. Again, he's the CIO at Idaho Persey. It's a distribution of daily price movements in the S&P 500 going all the way back. This is the decade of the 2000s. And he makes a very interesting comparison to an earthquake seismograph. Here in California, we don't make those comparisons because it's too uncomfortable. So, too close to home. But what I would say is look at that middle of the decade. And if you remember, that's when we had spectacular returns. Well, that middle of that decade is when our normal investment policy works very effectively. Returns are not widely distributed. The markets tend to move and run, and we can invest and we can stick tight to our asset allocation. I highlighted two specific periods, the 2001, 2002 period. Obviously, we're coming up this Sunday on the 10-year anniversary of 9/11, and the volatility we experienced then. And then the other daily price volatility we experienced in 2008 during the global financial crisis. I put the last little circle on this time period with a question mark. We don't know, but we are starting to see a wider seismograph shift that's outside of what we would expect as the normal distribution of price movements. Daily volatility is up, something you already know. We measure it by the VIX. We measure it through a lot of periods. So the difference between what we're saying and what, say, Bob Maynard and others are saying is our policy works really well in that blue period, but we need a different policy and different tools to operate in those yellow periods. Now, to their credit, they'd point out those yellow periods should be random, they should be infrequent, and you should weather through them and just survive through them. If you had only looked at the asset allocation or only looked at the investment performance once every 10 years, measured us all over a 20-year time period, we could say, yes, we're fine with that. But we know we live in a series of one-year events. As Alan said, we live in a geometric life, not an arithmetic average life. So I'll wrap it up real quick. We've got 6 risk factors that we talked about that Neil and Stephen will go through. The 4 that are in yellow, I want to congratulate this team. They have worked very hard this summer to be able to actually measure those and get good statistics on those. Alan said to me at part of the summer, he couldn't believe how much time John Linder and Neil Rue were spending up in Portland on this project. But I think this is really maybe not groundbreaking, but certainly for a public pension plan, it's at the front edge of the curve. The last 2, leverage and regulatory risk, are much more subjective and we're finding much harder to figure out how to measure. But those are the 2 that we have left, and that's why they're in green. We've still got to work on those. So the goal with this, you always hear me say it's a marathon, not a sprint. I don't want to get us down to daily performance, and as I was emailing you morning, noon, and night, we don't want to get that myopic in our perspective. So we want to complete the 6 risk factors. That's our measurement. But then we want to develop more risk tools, which is our management of what we're measuring. What Stephen and I are zeroing in on is the idea of a second investment policy for periods of turbulence. So basically, when two of the risk factors go yellow to red, we would shift gears. And I guess I would ask you to think about that when the little light goes on and the pilot says, turbulence, put on your seatbelts. You pull out a different management policy that says this isn't a normal time period. It's a wider distribution of returns. We're going to use more tools and we're going to be more proactive in managing the risk in case this is a left-hand tail event. And that's where it leads me into my last two bullet points. One, risk management. Alan has said to you before, risk management is not free. If you focus in on risk, you're going to be sacrificing the return. My point to you would be, think about us as regular people in our lives. I said gladly pay, but we're almost eager to pay a premium. We pay a cost to let somebody else insure the left-hand tail events in life. Our fire insurance, our home insurance, auto, life insurance, all of those are to handle, somebody else gets to deal with that extreme left-hand tail event. We'd rather pay the premium and not have to collect on our policy. And we're glad to, that's why I said we're glad to not collect on the policy, to just pay the premium on an annual basis. If we implement this, we should expect there should be some incremental premium, a little bit of a cost to do this. It will hurt our performance a little bit, but we'll feel that we've protected ourselves. And then lastly, as we've said before, risk is a single word, but it's not a single number. It's not the net asset value. It's not the VAR of the portfolio. It's a variety of things, and that's why we're coming back to a variety of tools. So with that, I'm going to kick it over to Stephen and to Neil to get into the meat of it.
Good afternoon. Thank you for this time. Because I wanted to start off and just talk about, I have a presentation, a brief presentation, but I want to spend a little bit of time and give you an overview of where we are today in the risk management framework and how we're developing the process. But before I get into the presentation, I just want to say that we really spent a lot of time on this project, and since the beginning of this year, after you approved the 6 risk factors, we really began to talk to other pension funds, money managers, and to look at their practices in terms of risk management. And what we found out is that there's really no best practice out there, is that we can take a little bit from each of the various entities that we talk to and really try to piece together a framework that's really appropriate for CalSTRS. What I want to do today is just spend some time talking about risk management and some key objectives. What are we trying to accomplish with risk management? Also want to spend some time about how we monitor risk over time. How do we define risk? What is risk to us? And then we want to talk about how risk changes over time and how it's not really static and that it's very difficult to measure at times. And as Chris alluded to before, one of the things that we're really concerned about is the really left tail risk. And what do we do? What can we do to mitigate that risk? And lastly, what we're going to talk about is that we're going to look into our toolbox. So what do we currently have in our tool chest right now to help us manage risk and to deal with risk specifically on the left tail? And what potentially can we add, new tools can we add to the toolbox?
Hit the mid down, the big down. You guys do that in the back? There we go.
Okay.
All right, there we go. Just did that.
Okay, thank you. Sorry about that. I'm not an expert on this part. And so I'd like to begin just by going over some key objectives for risk management. The first one is that what we're trying to do is really meet the return target of 7.75% and lower the volatility return profile. And like we said before, what we're really concerned about is the drawdown on the portfolio in really turbulent market periods. Another objective is that what we're trying to accomplish with risk management is we want to watch the market data. We want to watch the market market data as well as the economic news and anything that's related to that can affect the risk in the portfolio. And what we're trying to do is develop early warning indicators of potential market regime shifts. If we can anticipate what these regime shifts are or anticipate, then we can begin to look at our underlying assets and try to understand how the assets will behave or what the performance might be as we go through these regime changes. We want to provide clear insight into potential drawdown outcomes. So again, we really want to have emphasis as we sort of looking for as we anticipate regime changes, and we want to understand if there's any risk buried in the portfolio that will cause a drawdown. And then what we wanted to do is also to seek to reduce the downside risk. So as we anticipate and understand that there's risk in front of us, we want to try to prepare ourselves in advance and to develop strategies in terms of minimizing risk. And one of the things that we'll talk about later is we'll talk about hedging strategies. And the last question, or the last point, is what if? And I think this is a very important point, is that as we look at the information, as we gather the information, we always want to ask ourselves, what if? What if this was to happen? What will be the impact on the portfolio? So as we're gathering all this information, we're doing a lot of stress testing, a lot of scenario analysis. The next slide is I just want to briefly spend some time and talk about what do we know about risk. We know that risks are in the portfolio because they earn a risk premium. And we know that the reward for risk is the potential for a greater investment return. So we need risk in the portfolios in order to accomplish our goals and generate a return of 7.75%. So over the long term, reducing risk exposure can reduce the risk premium earned. We know that risk is uncertain, so we can't know with forecast with absolute certainty what the macroeconomic environment is going to look like. And we don't know for certain how the asset classes will behave. We talked about briefly about tail events and that they're important and we need to be on alert for tail events. And last is that we need to really place a greater effort on management of risk and better understand the adverse outcomes. This next slide here is when we think about risk, what we're trying to do now is risk, we're trying to decompose and try to understand, okay, well, what does risk really mean to us? And the way I kind of think about it is that if you go down to the middle, I think of really two basic components of risk. And so I think of it first as there's a market risk and there's what's called a residual risk or the active risk. And in my mind, those are the two basic components. When we think about a residual risk or active risk, what we want to know is that we want to look within our portfolio and we want to understand what bets or how are we positioning our portfolio away from the passive benchmark. Then we want to look and try to understand is that are we being compensated for the risks that we're undertaking. Now with respect to the market risk, what we're building into our process, into our framework, in which Chris identified earlier, he talked about the 6 risk factors. And so far we're able to model 4 of the 6 risk factors. What we're really saying here is that we're trying to get an understanding when we talk about market risk, what's really driving, what are really factors are affecting the risk and what's driving the returns. So we identified 6 large groups and we're going to get into a little bit, we're going to talk a little bit about that in the next slide. Can you flip to the next slide, please?
The way the remote works.
Okay, good. Okay, on this slide here is kind of going back to that previous slide, and you think about the 2 components of risk. We have the really the market risk and the active risk. Now, what we really want to focus in on is really the common risk factors. So what we're really saying here is we're trying to think about now in terms of what are really things that we can observe and that we think that are really driving the performance of each of our asset classes and a total portfolio. And so we engaged Neo and his staff, PCA, to really help us think about this. And so the first thing that we did was we canvassed the market and we said, okay, what are factors that we think that are embedded in our portfolio that really help us understand what's driving the performance? And so we started out, we identified 12 different measures. And so the 12 different measures are bullet point here on the slide. The next thing that we did, the next step that we did is that we took these 12 different measures and then we forced it, or we assigned it to one of the 6 risk factors. So essentially now we're just saying, okay, we have these 12 different market measures or economic measures. Let's put it into one of our 6 risk factors, and this is how we'll eventually want to report the information to you. Okay?
Stephen, can I add to that? So
Sure.
if you look at the very top, the growth, inflation, interest rate, market liquidity, what you're going to start to see from us is either a gas gauge from green to yellow to red or stoplight. We haven't quite figured it out. But we'll aggregate these up. You won't see all the underlying 12 figures, but know that those figures are bubbling up to then create a gauge of, is growth solid? Or obviously right now we'd all put growth in the yellow to almost red. You know, growth is terrible. Alan said inflation's creeping up. So it went from nothing to where it's getting close to the yellow stage. That way, and you'll see that in your quarterly reports, and you'll see it from me in the CIO reports. That way you'll get that stuff on a common basis. We'll also start using this in our investment recommendations to show if Mike's buying an office portfolio, where is it adding to our risk? Is it mitigating one of these, or it increases our inflation risk or decreases our inflation risk? Stephen and Neil will constantly be looking at those underlying measures, and they have the ability, it's a multi-factor model where they can say, you know what, let's take under inflation, uncertainty, oil price, gold price. They can take a look at that and weight those at different weightings. And as Stephen will show you, they'll change over time and how their influence will change over time. So we'll have the ability to weight their factors. Carolyn, you were going to ask something?
Mean volatility when you're talking about something like gold price? Yes. What do you mean by uncertainty? Volatility?
That's exactly what it is.
Okay.
And the point there is it's not the level of the thing, it's how the thing's moving around.
Right.
So like on gold prices, if you see gold prices moving around, people don't know where gold's going.
Right.
So that's uncertainty, that's risk. That's what we're trying to pick up here.
Right.
I just have a couple comments, Steve. So just going back just to reiterate, you have this risk metrics that we've introduced to you over the last, let's call it 3 or 4 semi-annual reports, and that has been an excellent way to get the discussion going, and Alan really pushed us to do that. You've all been able to, and Alan used those today to just sort of talk about what's happening. This is not a substitute, but it's a build on from those risk metrics, and those risk metrics that we've been talking about are not going to go away. They will actually be mapped into the modeling process that's going on here. So just wanted to point out we're not replacing one thing with another thing. I think that's it. I had another thought, but I can't. It'll come back to me.
Next slide.
Okay, this next slide is, this is actually our risk exposures in our portfolio. And what we've done is that in the previous slide, we talked about the different factors, and we talked about how PCA was able to build a risk factor model, multi-risk factor model for us. And so we thought it would be interesting to show you the output from the model. And so we have a snapshot here. And the first thing I want to draw your attention to is that if you go to the bottom line where you see the adjusted R square, that's one of the things that we want to look at. We want to look at the model and see how well is the model actually being able to measure the identify factors that explain return variance in the portfolio. And so when we see something like 88% across public equities or even 77% across the total portfolio, the bottom line is the model is doing a really reasonable job of helping us understand what are the drivers in the portfolio. So now we go up towards where it says macro factors. You see our 6 risk factors listed there. So one of the interesting figures is that even though we haven't been able to model 2 of the factors, which is the leverage risk and the government risk, if you note there is that in the public equity space, about 2/3 of the risk can really be explained by the growth risk, okay? And then with respect to the total portfolio, about half the risk, again, is due to the growth risk.
Stephen?
Mm-hmm.
The growth risk is that the growth is going to be so slow?
GDP growth.
It's
either high or low.
Okay. So the higher the percentage is 67%, the higher that is,
It just means that, sorry, Stephen, I'm jumping in. I guess I would explain it means that the equity portfolio is driven by, is explained by global growth, is correlated to global growth. And it makes sense when GDP and the economy is really strong, it's going to show up in stock prices around the world. And that's the best way to think about it. So if we can be good at measuring what future growth is going to be like, which is a challenge, but it will help us give an indication about what's the strength or the likelihood of our equity portfolio. And whether we want to hedge that risk or put the gas pedal and take on that risk.